following market update content was created by Ivan Gruel, Chartered Financial Analyst and Chief Investment Officer at Avantax.
Hello, my name is Sandeep Varma. I'm the President and CEO of ATS Wealth Management. Today, we will provide a market update for January. We'll start with a recap of 2022 and all that transpired, followed by our outlook for the economy and the markets going forward. Let's get started. 2022 was a tough year for investors as economic uncertainty, geopolitical instability, and higher interest rates and inflation took their tolls on both stocks and bonds. Following 3 consecutive years of double digits performance, the S&P 500 index was lower by about 18% this year. While still firmly negative, international stocks outperformed domestic stocks, with the MSCI EQX US index falling negative 15.5%. In bonds, the Bloomberg US Aggregate Bond Index fell more than 13%, recording its worst calendar year performance since the inception of the index in the early 70s. The best performing sector this year was energy, which gained more than 60%, partially offsetting losses in other areas of the market. Excluding small gains from utility sector, every other sector finished in the negative territory for the year. As shown in this chart, inflation became a leading global concern in 2022, and the year was dominated by the Federal Reserve and the fight against inflation. Entering the year, markets remained optimistic that post-COVID recovery would continue as supply chain issues started to resolve and the S&P 500 reached new all-time highs in early January. In February, Russia's invasion of Ukraine stoked the fire of inflation, sending energy and other commodity prices skyrocketing. By June, inflation had quickly become the primary concern for consumers around the globe. In response, the Federal Reserve quickly shifted course and began aggressively hiking interest rates throughout the year. As the Federal Reserve fight with inflation escalated, as this chart shows, the Federal Reserve implemented the rate hikes in 7 consecutive meetings in 2022, leaving the federal fund rates at a target range of 4.25% to 4.5% by year-end. These actions by the Federal Reserve throughout the course of the year are finally working. CPI has been falling since June, benefiting from cooling supply chain pressure in warehousing and transportation. Recent weakness in the US dollar, along with lower energy prices, have helped with lower inflation as well. We believe better condition lies ahead for investors. The Federal Reserve is now nearing the end of its tightening cycle, and much of the weakness in economic growth is currently reflected in valuation. This slide shows 10 of the major asset classes and their valuations according to Z-score, i.e. relative richness or cheapness to history. The diamonds are the valuation at the end of 2021, and the circles represents the current valuation, showing that most asset classes are considerably cheaper today, offering a good entry point for investors. After posting an impressive real GDP growth of 5.7% in 2021, economic growth slowed significantly in 2022 with expectations of real GDP growth for the year 2022 of less than 2%. Consumer spending has held up surprisingly well, but as consumers spend down their excess savings to keep up with inflation, this tailwind will likely dwindle and consumer spending should slow. As investors look forward in 2023, the big question will be whether the Fed can continue to slow down the economy while avoiding a prolonged recession. As we move into the new year, we urge you to make your financial plan a top priority take a long-term view. After the recent global reset in valuation, we are optimistic about the investment opportunities and higher potential returns in the future. So that's what we have for you this month. Thank you for watching, and thank you so much for the trust and confidence that you have placed with us. Happy New Year, everybody. We'll see you next month.